Welcome back to EDS, and in this video I'm going to show you how to grow a small account by writing options contracts, collecting a premium upfront and generating consistent returns. So there's three things that we need to tailor our strategy to specifically for small accounts. And the first thing is we need to trade small underlyings. The second thing is we need to trade high implied volatility. And the third thing is that we need to ensure that we have high probabilities of success. So the first thing you want to do is navigate over to any equities underlying. We've got TQQQ up at the moment. It doesn't matter what you choose. All equities have the same expiration dates. The purpose of this step is simply to pick an expiration date that we can use moving forwards, and the one that we choose needs to be between 30 and 60 days out in time. It also needs to be a monthly, not a weekly or quarterly expiration date. So the only one that actually fits that criteria right now is February 21st, which is 56 days away. Now we can take that information, 56 days, come over to our watch list and simply filter out any and all earnings or any and all underlyings that have an earnings announcement over the next 56 days, because that's how long we're looking to be in these contracts for. We don't want an earnings event to come along and increase volatility. The higher the volatility, the higher the options price. Remember, we are shorting these contracts, which means that we are selling high and buying low. We want to sell when volatility is high and then buy back once volatility has contracted. Also, as a side note, volatility is mean reverting, so that helps us a lot. Now we also want to remove anything that has a low liquidity rating level. This is simply because we are only interested in trading liquid markets. The more liquid a market is, the tighter the spread is. The spread is the difference between your bid and ask, and it's what you pay every time you get in and get out of a position. So the tighter the spread, the less you pay, meaning the more profit that you keep. So once we've got all of that sorted, we'll be left with a watch list that looks something like this. This is simply a pre-made watch list. You can use any watch list that you like, and I personally like to order everything from high to low IV rank. Again, we want to sell when IV is high and then play the contraction back down to the mean. And at this stage, we want to go through everything on this list and see what would fit well inside of our portfolio. Keep everything nice and diverse, use common sense, and you'll be fine. You also want to make sure that the underlying that we choose is small, i.e. $50 or below. It can be more, it just depends on how small your account is, but generally speaking, the larger the underlying, the more buying power that will be required to open and maintain a position. So anything kind of below $50 will do. We also want to make sure that we have a high IV rank. Anything over 50, sometimes over 30 can be considered high as well. And straight away, DVN is what is standing out to me. It's trading at just over $31. It has an IV rank of 49.6, an absolute IV level of 32%, and I think it's worth taking a closer look. So if we go over to the trade tab, we can now simply select the expiration date that we've already chosen, which is February 21st, and we'll now be presented with the options chain. Now at this point, we can choose what contracts we want to sell and where we want to sell them. We're going to sell one call and one put just to keep it very simple. Calls are on the left, puts are on the right. We have a orange horizontal bar that shows us where the price of DVN currently is with respect to the strikes. And we have a vertical orange bar that shows us the expected move of DVN over the next 56 days. Now, out of the three things that we mentioned at the beginning, we've chosen a small underlying, and now we need to, well, we've already made sure that we have high implied volatility because of the IV rank. So all that's left to ensure is that we get a high probability of success. So we want to be selling our contracts outside of this expected move in order to give us a high probability of success. Somewhere around the 1 standard deviation mark will do. We've got a 12 delta here. Ideally, we'd like to pick something between 15 and 20 deltas, but we're limited on strike selection here. So the 12 delta at the 37.5 strike looks good, and there's also a 16 delta at the 27.5 strike on the put side. So we've basically created a range for ourselves now between $27.5 and $37.5 for DVN, and it's currently trading at 31.27. So we are pretty much in the middle of the range, and we want price to stay within this range. And if price stays within this range, at expiration, which is in 56 days time, we will keep 100% of the premium that we collect up front, which is this number down here, 67 cents. You would multiply that out by the contract multiplier of 100. Each equities contract controls 100 shares of the underlying, so that would give us a max profit of $67. Our broker would require $312 upfront in order to open this position, which gives us a very nice and respectable return on capital for a naked position. Now, what is the chance or the likelihood of this happening? Well, we've got a pop of 75%, which means pop is probability of profit. So we've got a 75% chance of making at least 1 penny on this position by expiration. And if we want to get out of this position early at, say, 50% of max profit and not wait all the way to expiration, then we have an 86% chance of being able to do so at some point in the next 56 days. So we're looking at between 76 and 86% chance of success. So that is a very, very high, those are some very, very high probabilities of success. So that ticks all three boxes. We've got a small underlying, therefore requiring a small amount of buying power, only $300. We have a high implied volatility environment. The IV rank has just increased now to 51.9. And we have a very high probability of success of between 75 and 87%, depending on how long we want to hold on to this position for. And that's basically it, guys. That's how you find positions and grow a small account. You can just keep doing this over and over again across multiple different underlyings for as much as you can, based on the amount of buying power you have available in your portfolio. And over time, the wins will just add up, and these numbers are adjustments. So a position can start to move against you. You can manage it, make adjustments, collect more premium along the way. So these numbers don't include that. So generally speaking, you'll end up in a better situation than what's outlaid here. Also, implied volatility for the most part is overstated. So although we're looking at between 75 and 85% probabilities of success, in actual reality it's probably a little bit higher than that in most cases. So as long as you keep doing this over and over again, you'll be absolutely fine. The only other thing that you do need to keep in mind is the size of your positions, denoted by your buying power requirement. How do you know how much buying power you should be allocating to your positions? Well, in order to figure that out, we've created a free position sizing template. The link is in the description. And the way it works is you enter in the size of your portfolio, you then enter in what the current VIX level is, and then everything will then be automatically calculated for you. And at this point, you just need to use this information to form the backbone of your portfolio. It will tell you the maximum amount of buying power to allocate to any single defined risk position, undefined risk position, and it will also tell you how much of your portfolio you should be allocating to short premium strategies in general. As long as you follow this over the long term, you'll be absolutely fine. And if you want to learn in more detail about what we do and how we do it, again, link will be in the description. This time click on EDS Premium, get yourself signed up. Inside you'll have access to our portfolios that will allow you to see the positions that we're placing, how we're managing risk, the adjustments that we're making, all in real time. There's also a full course inside, so no prior knowledge is required. We will teach you everything that you need to know. And it is a private community, so if you get stuck for any reason, you can speak with myself directly or with other like-minded individuals. There's a 100% money back guarantee, so after 6 months, once you've gone through the full course and followed some of our positions. If at that point you haven't been profitable, then we will work with you for free until you are, or you can simply request a full refund. So it's completely risk-free on your part, and right now it's £1 a month to join. It's so cheap because we've just launched. The price will be increasing. However, once you're in, the price is locked in for you for life. So you are definitely rewarded for getting it early, and the aim of EDS Premium is to get you to a point within 6 to 12 months to where you know what to do, you know how to write contracts, you know how to collect premium, you know how to manage risk, and you know how to basically do everything all by yourself without any external help or influence, essentially learning the skill that no one can take away from you forever. And we aim to get you to that point within 6 to 12 months. As much as you are always welcome to stay and be a part of the community moving forwards, 6 to 12 months is all that you should need, and you should be good to go. So with that being said, I will see you guys on the inside.